Play the OJs for the love of money.
For the Love of
Yes,
Money by the
yes.
OJs. Sure.
That's what today
Playing
is
on
about.
Spotify.
That's what today is about. Uh-huh. This is what today is about. And not so much saying you gotta love money. Not everybody loves money. I get it. But we all need money. No matter where you are, no matter what your situation is, you need money. Maybe you need a little bit of money. Maybe you need a lot of money. But I guarantee you need some money. Today we're gonna talk about how to get you a little more money or a lot of more money. Okay, let me shut that down before they flag me. Hello, America. Hello, world. Hello, you. Welcome back to the Pod is Good podcast. It is your new best friend, Cashmere, California. This is episode 19. Pod is good. And all the time, if you know, you know. If you don't, keep listening, you'll find out. Today, an incredible show is brewing. I have brought back James, the investment shark, because in our last episode, I got a lot of questions. I got a lot of texts, a lot of messages, people asking, what does this mean? And how do I do this? And that was a really great idea, but I don't know step one. And don't you hate when that happens? Like you get this great inspiration or this great idea, or someone tells you about this great path, and the end of it sounds amazing. The middle of it sounds accomplishable, but the beginning, you have no clue. What's the step one? I'm down for the struggle. I'm down for the grind. I'm down to put my blood, sweat, and tears into getting to this. But what's step one? Without step one, step 10 is irrelevant. So today, we decided let's begin there. Whether you are 14, 44, or 104, if you just want to learn about investing, what does it mean to invest? How do I invest? How much do I need to invest? What am I got? What are the benefits of it? Is it all just hoopla? Is it people just talking? Is it only for people to have a ton of money? Today you're gonna find out. We'll answer all those questions today, and more, and more. So welcome, welcome. Get ready to take some notes. Sit down, relax. You know what I'm saying? Hopefully you can relax. I know it is a Wednesday morning. So, but I don't know when you're watching this. You might not be watching this live. Maybe you're watching it later on. Maybe you go back and listen to this podcast in its audio version on Spotify later tonight when you got the time. I don't know. But whatever you do, take notes. Don't let this information get into your ears and leave out the other side. You need this. Trust me, everybody needs this. Even people that are already investing need it, because sometimes you got to figure out how do you explain to someone else what step one is. You know what I'm saying? Sometimes your step one happened so long ago that you're like, well, this person did it for me and they sent me here. And then I guess you don't know how to make it simple. And if you can't simplify step one, it's not a great step one. So please take notes, pay attention. You're here for a reason. I know that. You know that. You're here for a reason. Let's bring in our guest. Ladies and gentlemen, the investment shark himself, my guy, my friend, my RV buddy, Mr. James Anadon. How you doing, sir?
Yeah, I'm doing good. How are you?
I'm great. I'm great in anticipation. I've been waiting for this episode since we talked about it.
Right
Since
on,
we
man. I'm
talked about
excited.
it. Yes, yes. So if anybody wasn't here last time, James has an amazing story. I will put the link to his first episode with us in the description so you guys can hear about his amazing triumphant story and how he got to where he was, what his childhood was like, what inspired him, what music he loved, the people that poured into him, and how he arrives in the place that he is today. But today, we start step one. I know you heard the introduction. I was telling people a step one is irrelevant it might as well, you might as well not even say it if you can't simplify it.
Yeah.
If you can't break
absolutely.
it down to that person's level, they're at, you,
Let's do it.
all right. So how like
Broke up there. Can you say that again?
no worries. I was saying, okay, let's get started. So where would you start on this?
Yeah. So can you hear me good? Okay, good. So, I mean, typically, so from an investment landscape perspective, I think there's a lot of demystifying that sometimes needs to happen. Some individuals come to the idea of investments maybe because they were taught this or they just don't understand, but they think that it's gambling, which it certainly can be if done in a particular way, which is not what I'm speaking on today. I just want to speak on it from like a whole just from a holistic standpoint, as if you were an investor looking to save money for retirement. So I'll start there. We have a
Okay.
long time horizon. We are investing money for a long time to help us in better our future and have a comfortable retirement. So that's kind of the basis I'm coming from when we start this. But from an investment perspective, we think about what is an investment because we make investments all the time. It could be time with our children. It could be investments into maybe a business we're starting. Sweat equity, right? We put a lot of time and work into something, and that's an investment. But in
Absolutely.
this case, we're talking about taking your hard-earned capital, putting it into an asset that we expect some return out of. And that's what I'm speaking on from an investment standpoint, and mostly in regards to the capital markets, like the stock market, right? Everyone thinks of the stock market. There's many markets out there. And some of those markets are, the real estate market, you have the bond market, you have foreign exchange markets, which are currency markets, you have the stock market, and there's many others, right? Cryptocurrency markets. So that's a newer one.
Yeah.
And all of those just exist in that realm of investment. There's private investments, but we're mostly talking about the public side where you can go onto an exchange and purchase them that day and they're in your account, right? And so what I'll do is I wanted to pull up a PowerPoint to kind of take us through this just from a high level, because there's some information on here that's good and I want people to be able to either take screenshots or take a note from it. So I'll go ahead and share that. And obviously I spoke on some of this already, but this is just an introduction to investments, an overview of the capital markets, and all the capital markets are the public markets that you see on CNBC, all the tickers moving. That's the capital markets that you're looking at there. We've gone through this. Like in the traditional sense, investing is the act of using your hard-earned capital and assets such as stocks and bonds and real estate with the expectation that your money will grow. Right. It's not always guaranteed, but our expectation is that at least over the long run.
Right.
And there's many different markets, right? Commodity markets is one I missed, right? There's real estate, stocks, commodity markets, which would be like buying oil or corn or gold or copper, right? And each one of these markets are very important to just how we are economically from a world economy, even down to the U.S. economy. They're all important. They create liquidity. They give us the ability to grow our own net worths, and they give us the abilities to start businesses, whether you're, borrowing money or investing in them, right? There's one important overlay here that I want to start with and stress. There's only two ways to invest your money. You're either an equity, you're taking an equity position. That could be like it says here, purchasing a company, or even buying a house, right? When you buy a house, you're taking an equity stake in that position, in that asset that you own, even if you live in it, right? You're an equity owner.
Right.
When you're the person who lends out money, you're taking a debt position. So say the person who has your mortgage on that property, they have a debt position, right? What they are expecting in those from an equity investment perspective is you purchase a piece of that asset, whether it's a company, whatever it may be, and you're expecting to share in the cash flow or the value of that company or asset. With a stock, if you bought a stock, you're expecting a dividend mostly, right? Not every company pays a dividend, and if they don't pay a dividend, you're expecting some type of value and increase in the stock price. And even dividend companies, they increase in value, but you're expecting some type of a piece of that cash flow that company is earning. That's why you're buying that investment. So an equity investment in this case, and what we're speaking of just from a high level sense, is a company, a stock, right? When we purchase a stock, we're purchasing a company, and we expect to receive the cash flow or some type of value from that company. And that's based off of many different things that I don't want to get into today because we're going a little bit high level. And from a debt investment,
go back. Can you go back to the last screen? So really quick. So
yeah.
when you purchase a stock, you're purchasing a piece of a company. Can you explain the difference in like someone that's a stockholder compared to someone who founded the company, or someone who's an officer in the company, someone who actually go ahead.
Yeah, so absolutely. So if you're the founder of a company and you go public, essentially what you're doing is you're selling shares of your company to the public. So now everyone who owns that actually owns the company as well too. Now you may have a much bigger slug of it, right? Because you receive shares on your own just for all of the time and effort and money that you spent on that company. But if you're a CEO, then not only do you have shares in the company, but you also have you have a position on the board, and you help make decisions on everyday practices of where to take the company. As an owner of the company, a common stock owner of the company. So if you just go on to, say, for instance, onto some whatever trading app it is, and you decide to purchase Apple computers, you actually have the ability to vote on things that they do. So you have voting shares. So you are not only an owner of the company, but you also have some say in what happens. And obviously there's a lot of owners, so it really just depends on which way the vote goes, if you get your way or not.
Yeah.
But typically as an owner, you have the ability to vote. You have the ability to vote a CEO in and out. You have the ability to make decisions on behalf of the company, as at least as a group, certain decisions, if you will. And then you also have, because of that, you also have the potential to receive some portion of the cash flow that the company produces.
Right.
Free cash flow. So it's definitely it's a good factor in investing, and we'll get more into the risk side of it here in a little bit. But that is what you are if you're taking an equity investment. You are a owner of that company.
Thank you for breaking that down, because I do think, especially for the younger people listening, they might look at buying stocks as like, oh, that's just, what older people do. You're buying stocks, stock market, blah, blah, blah. But they don't realize what the stock represents. So they don't realize there's actually a cool factor in you loving a company like Sony or Nike or Apple or McDonald's. And if they're a publicly traded company, you buying a stock, you can actually say, like, I own a piece of that.
Yeah.
You love going to wherever, Taco Bell. If they trade publicly, you can actually own a piece of Taco Bell and not just buy into it. And that's a different way for especially a younger person to kind of view that, instead of just, I'm buying a stock with some 3 or 4 letters that I don't know what it means, but they say in 50 years I'm going to have money, whatever. It's a little cooler just to know, like, yo, you own some of Adidas now. I wish someone had told me like that. So, okay, cool. Sorry about that. Keep going.
Yeah, absolutely. So you become an owner of that company, right? But there's also the other side. Companies also need to raise money to grow their business. Sometimes they do that by selling stock, right? So that's essentially what they're doing. When a company goes public, they're selling shares of the value of their company to other individuals. And because they are selling that, they receive cash inflow. And sometimes they may
Oh,
need it to grow the business. Sometimes they do it just, usually it's because they need money, right? That's the
right.
reason why they do it, for some particular reason, some type of growth.
Yeah.
But another way that they raise capital is they take on debt, and you can purchase a company's debt. And essentially, what you're doing is you're becoming a creditor. So it's
Oh,
just like if somebody lends you money, a credit card company, or even so like for instance, with a house, as we used before. With a house, you may be you have the equity side where if you're purchasing a house, you're an equity investor, right?
right.
But say you have a friend or a family member that wants to buy a house and you have the money to help them buy it. And you're going to say, hey, look, I'll give you this $100,000. You're going to pay me 5% for the next 30 years. And then at the end of it all, the money will come back to me in what I gave you as well. So you'll get $100,000 back plus that 5% over those 30 years that you were receiving.
Oh,
So that's exactly what you are as a debt investor. You're lending money with the expectation to receive interest over that time, and at the same time receive your entire amount back. Now, there's a lot of caveats in there because there's different credit ratings that people have, and so your interest may be higher or lower, or your default, the potential for default may be a problem. But that's a little bit more in the weeds, and the point of this is just to explain what those two options are. You have an equity investment and a debt investment.
gotcha.
And you can purchase, the federal government prints debt. The Treasury creates what are called Treasury bonds, bills, bonds, or notes. And they sell them
Oh,
to the public. They sell them to institutions like banks. They
oh,
send them over to the Federal Reserve, and the Federal Reserve holds on to them and prints money, right? And essentially what that money is doing is giving that to the federal government so they can do what they need to with it. The federal, and then companies will hold on to that debt because the federal government is backed by the full faith and credit of the federal government. They tend to
oh,
be some of the lowest risk investments
right.
available, right? Because you're assuming that the Fed can print more money,
Just print it out.
assuming that we
Right.
can issue more debt, right? As soon as
Yeah.
assuming the Treasury can issue debt, we assume that the Fed can print more money and make good on that, on those interest payments at least. And of course, you expect at the completion. So, say you bought a Treasury bill for 1 year, and it's paying you 5%, which is a fairly real return right now because interest rates are higher. For that year, you'll say you give them 100,000 over that 12-month period. You would receive, you would be expecting to receive $5,000, right, in
Right.
interest. It's a little different than that, but just from a basic standpoint, that's what you should be expecting.
Right.
And they tend to be the lowest risk investments, so you're pretty much expecting to receive that. And if if the federal government defaulted, then that would be a real problem for the rest of the world, anyways, right? So,
True.
but anyway, so that's
Right.
what a debt investment is. So you have equity and you have debt. And when it comes to risk, and as we just talked about, senior debt down there at the bottom has a lower risk, which means you have a lower return. So that senior debt would be like treasury debt, or say a company like Apple issues a bond and you want to purchase into it. They may pay a pretty low interest rate on them, or they did for a long time, but they're a good company. They have a lot of cash on hand, but they may need some debt for something. Maybe they're opening a new manufacturing facility or whatever it may be. That's called senior debt. So it's got the low risk, low return. And if you look your way up to the top of this is called the capital stack. And if you look your way to the top, that's
Hold
where
on.
common
On your,
equity exists.
sorry to cut you off. On yours, because on mine it still says, what is an equity investment? Are you able to see?
Oh, I'm sorry. Let me see here.
Just want to make sure. I can't tell if it's just.
Oh, it shows on my side here.
Okay. If it shows on your screen, then maybe it's just mine. Anybody in the chat If you're taking notes, please let me know if you can see what screen are you looking. What's the title of the screen you're looking at now?
It says risk, equity versus debt.
Risk, equity versus debt. So just real quick, anybody, if you can, let me know if you can see that.
It shows on my screen here. I hope that you can see it, but essentially this is just showing you where risk exists within the market.
Okay.
At the top, which has the highest risk, of course, with high risk, you expect higher return as common equity. That would be like purchasing a stock. And I hate to make this all boring, but when you purchase a company, you're at the top of that capital stack and you expect a higher return because it has higher risk, right? That company, and essentially why that has that risk is where you stand in place to get paid if a company were to go bankrupt. So if a company goes bankrupt and gets delisted for whatever reason, all the way at the bottom of that capital stack is one of the first individuals to get paid. Well, first to get paid would be the federal government for taxes. They're always going to be the first. But then you're next in line. So you're a senior debt holder. That's why your return's a little bit lower because you're expecting to get paid out even if the company is assuming they have any money left, will pay you out for the debt that you hold. Now, if you're a common stock equity holder, you're all the way at the top. So the odds of you actually getting paid out for that are slim to none. But you take that higher risk for expectation of higher return. Right. So that's how that works when from a capital stack perspective, equity all the way down, all the way at the top, debt at the bottom, they expect to get paid back first. And then it kind of goes up the scale. And you obviously see preferred equity and mezzanine debt. I won't get into that too much. But essentially, that's how that risk to return scale works. Now, the question people have is, do I invest in stocks or bonds, right? And what I would say is typically you want to diversify between both. So say, for instance, you're a moderately aggressive investor, or maybe you're an extremely aggressive investor. You may only want to have 100% in stock. Now, of course, this is not financial advice. I can't give you financial advice on here, but what I can do is give you kind of an explanation for this. So if you are a young investor, say you're 20 years old right now, and you're putting this money away for a long time. We're talking about retirement. Say you're going to retire and you want to retire in 40 years. That's your goal. Then you may want to be a little bit higher on the stock side versus bonds, right? So maybe you have 90% in stocks and 10% in bonds. Or say you're a little older, say you're like my age, right? 35, 36, just turned 36. And you believe you're more of a moderate investor, moderately aggressive investor, you may want to have 80% of that in stocks and then the other 20% in bonds, right? It's called asset allocation. And what that does is it just diversifies your risk, diversifies your volatility risk, diversifies your time horizon risk, everything. So you want to do some type of a mix between that. And of course, if you're watching this, I'm more than happy to help you with that. You can reach out to me and we can do a risk assessment, figure out what that would be for you. And then when it comes to what the stock market exists of, we have what's called asset classes and subsectors. And I'm not sure if you can see my mouse on here, but essentially what this is you have asset classes on the left side where it says domestic equities, which is US equities. You have international equities second, commodities third, cash fourth, currencies, and fixed income. So those are asset classes. And I'll show you here in a little bit how to build out a portfolio with just using asset classes. But within each one of those asset classes, you have what are called sectors. So you have the technology sector, industrial sector, basic materials, energy, so on and so forth. And then if you drill down even deeper in those within technology, you would have things like communications, which would be like Facebook or Meta, right? Or you have what are called semiconductors, right? Those are a part of technology, right? Industrials would be, heavy machinery, those type of things. Basic materials would be like, metal, wood, copper, those type of things. And material companies, people who produce those. So as you can see, the market kind of has it moves from a very broad perspective, and you can drill down to it. And I just wanted to show this as this chart here as a representation of what it is. So you can kind of look at it in a scope of saying, hey, okay, as you get better and better at understanding the capital markets, you can drill down into things that are a little bit, more micro, if you will. However, for this, I just want to stay on a more what's considered to be macro type of a concept, and show you what you could do with an investment strategy by understanding everything that we just explained, and putting it together for yourself into the future, or relying on somebody else to put it together for you. So when you accept, one of the ways to do that is by accessing the market, whether that be a asset class, which we explained before, or a sector or a subsector. You can use ETFs, which an ETF is an exchange traded fund. And all that is it's an investment vehicle that tracks a particular index, whether that is an asset class, sector, or subsector. So if you wanted to buy all US stocks, there's an ETF for that. If you wanted to buy all technology, the entire technology sector in the US, there is an ETF for that. And so it's a very broad. There's so many ETFs out there, and they're all available for what, instead of picking individual stocks, you can get a basket of that entire subsector. And usually what that does is that kind of diversifies your risk instead of, putting it all on black, like maybe you just want to own Apple or something.
Right.
And so this helps you kind of define exactly how you should do that, or what this is to help you do that.
Yeah.
And so what I want to do here next is I want to show what a strategy might look like. And this is more from the landscape of what a 401k style investment is. You can do this same thing in an IRA or a Roth IRA or just a normal brokerage account. And the difference of those accounts are really just relying on taxation. So whether if it's a brokerage account, when you make a buy or a sell and you have any gains, you're going to have to pay taxes in that year. If it's in a traditional IRA, you make a buy or a sell, you don't pay any capital gains taxes in that year. But when you pull the money out, you take it as income, so you're paying income taxes on it. And if you put money in a Roth, right, and you're also limited on IRAs and Roths how much you can put in every year. But if you put money into a Roth, essentially it's post-tax money. So when you pull it out, at least if you pull your contributions out, there's no taxes on it. And then if you hold the account for 5 years, there's no federal taxes on it, federal or state taxes on it as well too. But as an investor, we need to know how to create a portfolio. So it's not necessarily what account you're putting it in, it's just how you create this portfolio. Number one, we want to diversify those holdings. We want to invest based on the time horizon that's appropriate for you. So for instance, we're talking about retirement at this point, this juncture. But say, for instance, you have a plan to buy a house in 5 years. Well, you're going to invest the money that you're putting for a house in 5 years much less risky than you will for the money you're putting at risk for 40, right?
Yeah.
And then second, or what's third from there, is sticking to the plan. And what I want to do next is show you exactly.
That's the big part.
Right. You got to stick to the plan. And I want to show you a strategy. This is a very basic strategy. People use it it's exactly how a 401k investor would work, right? And essentially what it is you have an asset allocation in your 401k. Every time you get paid, they pull money out of your check and shove it in there. Maybe that's once a month, maybe that's twice a month, or every week, whatever it may be. So every single week when they're pulling money out, they're putting it in that same allocation that you have for you, that they have within your account, which you choose, by the way. And that's called dollar cost averaging. It's a very simple strategy. For purposes of this, we're going to keep it in that long-term retirement context.
Okay.
You can do this shorter term, but it works best over the long term. And I would suggest that this be, or I would recommend people look and read more into this. Again, this is not financial advice. I'm more than happy to do that outside of here. But let's just take this as an example. Dollar cost averaging, again, is a very common strategy, similar to the 401k, right? You get paid every single week or month or whatever it is. Piece of that paycheck comes out, gets shoved into your asset allocation in your 401k. a young investor, like for this example, we'll just say like you're a young investor, you're investing for retirement, which may be 30 or 40 years in the future. So we're going to take this for purposes of you're going to put $150 on the first day of every month into a strategy that we've built out. And this strategy, we're using 3 ETFs, very broad. We're using the total US stock market, which is that VTI ticker right here. We're also using the all world, so every international stock. It's basically all stocks, but they take out all of the US companies. So this would be every company that exists outside of the US. And then we're taking a portion of that and adding it to our bonds. Remember, as we mentioned before, you want some allocation between stock and bonds.
Right.
So these two right here, VTI and VEU, are stock. They're equity investments. So that's 90% of our holdings. And then the aggregate bond index here, which is fixed income, we're only putting 10% in there.
Okay.
And so what I want to do next is show you an example of what that might look like if you say you started investing in 2010. We'll just say 2010 to start. So let's do that. Oh, I'm sorry. I have to go back. I think I have to share a different screen with you.
Oh, okay.
So we'll back task this asset allocation. So as an individual, we're putting these ticker symbols, and I actually will show you what the difference is if you invested in this or just saved in a savings account, so you can kind of see. So we're going to use VTI, which is the total US stock market, VEU, which is the international stock, all stocks excluding the US, so all international.
Okay.
And the aggregate bond index, so it's just the average bond index. And for the other portfolio was SHV, which is very, very short-term treasuries, very similar to what you would do if you'd be saving in cash. So we'll put 80% there, 10% in international, 10% fixed income. So that's our asset allocation. Again, and actually the good thing is with this, anybody can go to this and run these numbers. It's free. Go to portfoliovisualizer.com. I'm not plugging in. I'm not a part of that company at all. I just use it for myself from time to time. Well, let's go month to month. We'll start, or sorry, let's go year to year. We'll start at, say, what's a good year? 2010?
Sure.
Say if you were investing for 13 years till now, you were only putting in $150. You started with $150. They're going to contribute a fixed amount of $150. We're not going to adjust it for inflation, so you're only investing $150, although I wouldn't recommend that. I would recommend over time increasing that, right? And we're going to be putting that money in on a monthly basis. We're going to rebalance it annually, and all that means is sometimes, say the stock market does really well, this 80% holding could get closer to 85 or 90. And so what we want to do is have that portion get that when it gets out of scope, get moved and distributed evenly again. So we keep this allocation. That's really all what rebalancing means. We're going to reinvest our dividends. We're going to display our income, or we'll display our income here. Not going to have any benchmark because we have SHV as our benchmark. So you're saving the same amount of money in this strategy as well as cash, just to show a comparison. So let's run that. We'll go ahead and analyze that portfolio here. So as you can see, this is our asset allocation, 80-10-10 versus SHV, which is short-term treasuries, very similar to cash, probably actually has a little bit better yield to cash, but it's just for demonstration purposes. So for 13 years, if you just put $150 a month into it, you started with 150, put $150 a month in it. In 13 years, your balance would be $53,626.
True.
Right? That's the investment portfolio. If you just saved it in cash, you'd have $26,372. So it's more than double. It's more than 100% more. In value than if you weren't to invest at all. And the great part about this is that you kept that asset allocation. You just put money in. You didn't have to watch the stock market every day. You didn't even have to look at the account. You just kept pushing money in there every single month. The first day of the month, you put $150 in there. So that's the power of compounding, as well as using dollar cost averaging. But this is, again, it's just a very simple strategy. I wanted to explain what the market was, the two different ways to invest, why we, kind of mix between those two,
Huh.
stocks and bonds, and give just a simple understanding of not having to worry so much about what the stock market is or what it does. Because the reality is if you're going to use individual companies, or you want to drill down into some of those subsectors that I was talking about, like say you wanted to own, you know, driverless cars for some reason, you got to do some research, and this is just makes it simple. You don't have to do the research. Obviously, you do want to do some research on what you're choosing
Right.
from broad perspective. And I used Vanguard here, as many people know who Vanguard is, and as well probably iShares, right? These are
Yeah.
very big companies. You don't have to worry so much about them. Obviously, everyone can have problems, but they're well known and been around for a long time. And after 13 years, you're talking about more than double if you were just to save it in cash. And as a matter of fact, if you adjust it for inflation, and let's take off the logarithmic scale, if you adjust for inflation over time, we'll do an inflation adjusted. You actually your return on assets for cash, especially in a high interest, high inflation environment, goes down. Even if you weren't to add any money to it, say you had 30,000 in an account, just the last few years alone, you lost purchasing power value. And
Wow.
that's simply because that 30,000 bought you 3 years ago versus what it buys you now is a lot less.
Big difference.
So it's a big difference. And so your goal is to keep up with inflation and grow. And a strategy like this it would be a helpful one to research and understand.
And what was that? What was that URL one more time?
For this site,
Yeah.
it's portfoliovisualizer.com. You can go to Portfolio Visualizer. It's got all these free analysis that you could do, but if you just wanted to back test a portfolio, you could click it here and enter some of that same information I did. Give yourself some good information.
And just for the sake of, like we were talking about, younger people, let's show them a smaller amount.
Oh
As
yeah,
far as the investment, because $150, that's a pair of shoes. When you live in, when you're not only living for right now, but you also think that whatever the dream that you have is going to allow you to retire in the next 11 years, you might feel like, I don't need this 30-40 year plan you're talking about. uh, I'll be I'll be retired long before then, with
yeah,
millions just sitting in the Cayman. So let's
yeah,
do a much smaller amount. If they were like, okay, matter of fact, even if it's their parent or guardian saying, you know what, I'm gonna do it for you. I'm gonna get you started, and in 10 years we'll take a look at where your dream got you, which prayerfully it got you way beyond this. But if not, you'll have this much money just sitting here for your next idea.
yeah. All right, let's do this. I'm adding some of these. I'm going to go through an asset class portion. And the reason why is some of those ticker symbols didn't last, weren't around forever, but we'll just go from a basic perspective of asset classes, as we explained before. We're still using the same stuff, right? US stock market, all global stocks excluding the US, total bond market, and we'll use cash as another version of that. But let's do this. So let's add a cash flow in here. So let's do, let's say you did, I don't know, what's a good number? $55, $55, right? A month. You just did $55 a month. Contributed a fixed amount. Monthly, 55, rebalance it annually. So we'll do that same adjustment, 80, 10. And I'll show you one more thing when we're done here to show you how the power of time compounding can make a huge difference, especially if you're young starting, right?
Right.
All right, so let's see. Let's not do 1972. Let's do from, we'll do again 2010.
Okay.
So say you save $55 a month since 2010, right? Analyze that. I'm sorry, let's put 100% there. All right, we'll analyze that one. And so here you go. $55 a month will put your final balance at $21,616 after 13 years versus $11,213 if you were just to save that cash.
That's
But
double.
here's the power. Yeah, double, right?
That's double.
But here's the power of investing for the long term. So we just did that to 2010. So say you were 18 years old in 2000, right? And so now you're, what is that? 41,
Uh-huh.
right? Or sorry,
Since
yeah,
what age? I mean, since what year?
18 in 2000, you're 41, right?
Yes.
All right, so
18 in 2000. Yeah. 41.
yeah, 41. So let's analyze that same asset allocation during that time period, what your balance would have been. So now you're at 64,000, but you only have $23,000 in cash because you saved 23,000 of your $55 a month equals only 23,000. Maybe there's some small return, time rate of return 1.63%, right?
Yeah.
Versus 6.6. So you have 64 versus 23. Now, if we can even go back further. That's only 23 years. I mean, if you were to do, let's say you did another 10, right? So that's 30. Let's say you invested since 1980. You were 18 in 1980. You put $55. Now, maybe in 1980, $55 was actually hard to do. And you should increase that amount that you're saving over time. But what if you didn't, right? And you did for, what is that, 43 years? Just did that amount? I mean, you're talking $250,000 for 40 years at saving $55 a month. Now, $55 a month is not much. Usually an individual would be saving closer to between $200 and $400 a month on average in their 401ks. So
Right.
if you did that, say you did that between, let's just say you did $300. So we'll kind of split the middle. Started with 300, invested 300 for the last 43 years. And analyze that. Just consistently did it. You'd have $1.3 million over a 40-year period just by putting $300 a month into that.
Yo, I don't know if y'all picking this up. I don't know if y'all are picking this up. A lot of you probably already know it. Sometimes it's still good to see the numbers. A lot of this I know from talking to James, but seeing the numbers is very different. $300. First off, we understand not everybody can put away $300 every single month. Sometimes you're gonna have downtime, so take that into consideration. James understands that.
Yeah.
Life is life. You know what I mean? But if as consistent as possible, and if anybody's taking notes, there was a huge bullet point that James said earlier, and it said stick to the plan. That should be at the top of the page because it does not matter what you do with the visualizer. It doesn't matter how much you put in. If you cannot stick to it and stay consistent with it for the long haul, it does not matter. The system will not work. So from
100%.
From $55, you've seen what that can do. In 13 years, it doubles your money. James just showed you over a 40-year span what $300 can do. You're a millionaire now. All the work you're trying to do to get to millionaire status, you did it, like James said, without knowing the stock market, paying attention to the stock market, figuring out all these different companies and who has what. You don't have to do any of that. You'd still be in millionaire status.
Yeah. And you didn't even have to have an amazing job to save $300 a month. I mean, obviously the more money you make, the better, especially from a saving standpoint.
Yeah,
right.
Yeah.
But you didn't have to have an amazing job. I actually had a guy he was the janitor at the building I worked at. And that guy saved himself like $2.5 million over the 40 years that he worked as a janitor. So it's not necessarily what you do. Yeah, he stuck to the plan, and he worked at a brokerage firm when he was real young as a janitor, and one of the guys taught him something like this, and he just stuck to it. And he didn't even really speak good English, right? Like he had come here from I want to say it was like Chile or something, and he just cleaned buildings and saved every month, right? I think the most important thing is here too is most people might start small. They're going to probably start with $55 a month, but then over time that's going to grow to 200 and 300 and maybe one day it's $1,000 a month you're putting in there.
Right.
And that's totally
Right.
possible to do, especially when you're talking about a 401k, because when you get paid from your company through your 401k, so that they match with that too, right?
Right.
So say you put $100 in, and that's 3% of your income on an annualized basis, they're going to match you at another $100 on average. It depends on your 401k. Some don't match, but
Sure.
most do,
Sure. Sure.
right? And so instead you put 100 in, they're putting another 100 in, so that's really 200 that you're investing. And the cool thing about that is when you get your paycheck, they've already taken that 100 off the top before it got taxed. So you're getting taxed on $100 less. So that money's going in there, tax, not tax, it's tax.
Yeah.
Well, it's
Yeah.
not tax free. It's tax deferred, because when you pull money out of whatever your
Pull it out
401k
later.
is, you got to pay taxes.
Right.
But I wanted to show one more example, and I'll make this real quick because this is not supposed to be a boring kind of assignment, but I just wanted, just from a perspective of learning. Say, for instance, you started at my age, right? So say I'm 36 right now. I haven't saved anything, and I want to start investing, and I haven't saved a dime, right? But you're going to work for another 30 years,
Yeah.
right? So you're going to work for another 30 years. So that's 23. So let's go to, say you started as if it was 1992. So that's roughly 30 years right there. Actually, 1993 would be 30 years.
Yep.
And to save that same amount at 1.36 million, let's just say, and I don't even know exactly how to get there yet, but let's say you're going to have to save $1,200 a month, right? So the later you start, the more you're going to have to save if you want to hit that goal. And I don't even think we'll hit it. Let's see. Oh, there's 2.65. So let's say that's closer to 600 a month, right? 600. So now you should be closer to that 1.3. There you go, 1.342. So
Nice.
so you'd have to save right now $600 a month if you wanted, and put it in a good asset allocation. And now here's another thing. You're not going to always want to be 80% or 90% stocks. As you get older, you're going to want to dial that risk down, right? You're going to want to add more bonds and get rid of some of the stock, because as you see here, if we take the logarithmic scale, look how volatile that could be.
Yeah.
Anything can happen. You could get scared here, right? A lot of people did. You get scared there. That was recent. Get scared back here in 2008.
Absolutely.
And you may try to make changes to your portfolio. And again, that's why you stick to the plan. You know what your asset allocation is and this and that. So the reality is you're most likely going to want to dial down that risk over time. But say you didn't. You'd need to save $600 a month right now for the next 30 years to get to that 1.3 million. And I'll tell you, in 30 years, 1.3 million is not going to be the same it is today, right?
Good point.
You may have to save a little more. Now, say you're younger. Say you were 18 in whatever, what is that? 1980, right? 18 in 1980. Today's 2023, and you had the ability. Again, you probably start with 55, go to 200. Maybe at some point you're doing 1,000, right? But say the whole time you really did only put in $200 a month, right? I can't remember what we did that last time. Was it 250 maybe? Put $200 a month. It's going to be easier for you to get to that, close to that I'm going to say 250. Get close to that $1 million account by only saving, literally not even changing it, right? So you didn't even adjust it for inflation. So actually, we did adjust it for inflation. I'm sorry. So if you didn't adjust it for inflation, still putting $200 a month. $200, that's it. You're not, as inflation rises, you're not putting more in. You're not putting less in. You're at half, 640,000, right? Let's put it at two.
And that was for how many years? 30?
That's 43 years, right? So 250. So say we did 250. Let's see what that is. And sorry, that was adjusted for inflation. So you actually were increasing your allocation every single year by usually on average 3%. So if you started off with 100, the next year you were starting doing $103 a month, right? So, and then the next year you were doing $109 or $110.50, whatever that was. So it was adjusting for inflation at the time. But either way, even to get to now, if you think about it, to get to that 1.3 million at, say you started in, what was that, 1990? I put it at 93. you're not going to get there if you don't adjust it for inflation, right? So you'll be way lower than that. So you just did $600 a month. Now you're not 1.3, so you're $300,000 less at 600, not adjusted for inflation. So obviously you want to adjust it for inflation. Typically, the reason why that happened, why you will anyways, especially if you're talking about a 401k, is people tend to get raises every year that's close to 3%, which is
Yeah,
tend to be what inflation was. So
that
that's
makes
why they
sense.
have that. That's why they have that option on there. But you
But
can
it
run these
looks like
numbers.
even
Anyone
if
can
you
run these
don't,
numbers. Yeah.
but it looks like even if you don't, and I'm saying that because, you know, just again trying to simplify for people. Oftentimes when people start to think about stocks as like this very involved science that they need to figure out, that's usually what scares people away. And
Yeah.
so even the idea of, oh, I need to account for inflation and, well, what is inflation and does it change? What if there's another recession? Then do I adjust it? You know, people then get, it gets cloudy and
Yeah.
they get nervous. But so I just want to point out that everything you're saying is obviously correct. And alongside that, even if you didn't adjust for inflation, even if you kept just putting the same exact dollar amount and never changed it, you'd
Hmm.
still be 200% what it sounds like. Let me not give you an exact number. Let me just say you'd still be a lot better off financially than you would be if you just saved it as cash.
Yeah. Yeah. If you saved it
Period.
as cash, you'd have 250%, roughly 250% more, or 230 or 25% more than if you just saved it in cash.
That's crazy.
Yeah.
And
I mean,
you you
this is not even cash. This is like short-term treasury bonds, probably yielding close to 1%, right? So
and you did something that was interesting because we talked about doing it like a young person that's just getting started into it. But we know being a beginner does not mean that you're only 18. There's people that are 50 that are just beginning,
yeah. Yeah.
trying to save. You might be getting to the point where you're looking at, whoa, I didn't plan for retirement. Maybe the things that I thought were going to work out in my life didn't. I see what retirement money actually looks like on the table. I'm talking about retiring in the next 10 years, 15 years.
Hmm.
I need to start now. Yes, like James said, you have to be a lot more aggressive in your investment strategy, but just for kicks and giggles, let's see if someone did want to be aggressive for the next 10 years. Let's just say they're 55, they want to retire at 65, but they obviously want to be somewhat comfortable. What would
Yeah.
they have to put away to get a decent amount?
Yeah, and again, if you're 55, retiring at 65, I don't know if you would be a 90-10 investor, but and I wouldn't necessarily recommend that as a financial advisor, but
Right, right.
for kicks and giggles of the demonstration, let's do it. Let's go ahead and figure that out. So for the next 15, it will say 15 years, right? So
Okay.
let's say they're started at 50,
Okay.
right? And then they want to retire at 65. And most likely you'll want to run a financial plan to see when you want to take your social security as well too, because that's going to be a very important factor, right, for somebody who hasn't saved. But so I mean, social security is there. Maybe it does get reduced, maybe it doesn't. You should expect to receive something if you're at 55, right, or 50, hopefully. So let's just run that as a scenario. So we'll do 2000. This is probably the worst time to do it, right? Because between 2000 and I guess 2008. So you started investing at the top of the market in 2008. Probably like the worst time ever, but people do it. To get to that $1 million, right? Let's say, and we're not adjusting it for inflation right now. So let's say you needed to do $1,200. We'll double check that and make sure it actually fits. But I'm guessing that's going to be pretty close. That's only $555,000. Now, $500,000 is not a bad retirement amount.
More than
If it
most
were
people have.
right, if it were right now,
Wow.
obviously more is better.
Yeah.
But even to get to $1 million, you might need to save $2,000 a month, right?
Hmm.
Especially because you went through some difficult periods through 2008. Now, remember, even though you went through difficult periods through 2008 back here, you didn't have a bunch of money because you were putting money in every single month, right? And you were buying
Right.
at those lower prices as the market was falling. Of course, you're buying at higher prices too as it goes higher, but typically we tend to see the market go up and to the right, not in a straight line fashion like this red line would be if you were saving in cash. But the difference there is fairly astronomical. So let's analyze that if we were doing $2,000 a month. So now you're close to that $1 million range. You're doing $2,000 a month. If you were just to save it, you'd only have 409,000, and you only did that for roughly 15 years. And you kind of went through one of the most difficult markets, right? So 2008 here was actually pretty difficult. For investors. I mean, you lost 50% of your value. Luckily, you didn't have a ton of money in there, but let's say, or maybe you already had 100,000, right? Maybe you lost 50% of your $100,000 in 2008. How would that look? I mean, you still have a lot more money, right? But you lost a huge position. You started with 100,000. You were given $2,000 a month. Portfolio 2 did a lot better during that time frame, which is expected, right? Because it's not very volatile. Your account went down to 75,000, but you just kept putting $2,000 a month, $2,000 a month, $2,000 a month, and then all of a sudden, you're talking more than that's 100 and something percent, right? More, right? So 100 and what is that? Almost 15% more than if you were to save it in cash. But anyways, so.
That's good.
Yeah, I mean, anyone can run these numbers, and it's just obviously starting earlier is better, but it doesn't, just because you didn't start early doesn't mean it's not possible. You're just going to have to get real aggressive on your savings plan. Most likely want to talk to a financial advisor to help run a financial plan, and then stick to that plan. You can get this type of an asset allocation here from many different arenas. One of those that we talked about last time was Acorns, right? You just say, they'll ask you some questions, they'll give you an investment policy statement, say you need to be invested like this. They'll have those assets already ready to go. You just put money in it every month, and they invest it that way. You can do that through Betterment. You can do that through pretty much any brokerage firm out there now will help you do that. Once you figure out that asset allocation, if you want to do it on your own, or you want to hire an advisor outside of that, like myself, more than happy to reach out to me. More than happy to chat about that.
Yo, that is incredible. So, wow. Anybody in the chat, if you have anything to say, make sure you let me know. We kind of ran through all of it. First off, what is an investment? It's great for people to understand the difference in an equity position and a debt position. And then starting from someone very young that's working on, what's going to happen later in their life. So they're like a grasp on, the realities that, okay, hey, time is moving. You will prayerfully get to those later years. You can't guarantee that you're going to have this grand windfall. And now you might actually have the experience to say the likelihood of it is also, lessened at this portion of my life. But if I start now, I can still have a really great retirement. I still can set myself up to have some great golden years.
Yeah, and you don't have to do it in a complicated way.
Right.
Believe me, there are more complicated strategies to do, and maybe you can squeak out more returns in your portfolio.
Yeah.
It's definitely possible. But at the same time, right, a simple strategy sometimes works the best for some people. I'm more than happy to do another one of these where we can get a little bit more granular on what's available out there from a more complicated standpoint. We can even go through some other stuff like that. But for now, I think that was a pretty good overview to give some people either some hope or just some good insight. Not feel like the stock market is just a big gambling machine, right?
Right.
And demystify it a little bit.
Yeah, that was a huge fact, because most people probably do look at it like that. Like, I'm not trusting the stock market with my money. I'm not losing all my money, because that's kind of what you hear when people talk about the stock, that people that aren't really in it, people that talk about the stock market in general, it sounds like a gamble. People that talk about the lottery in general, it don't sound like a gamble. It sounds like, hey, it's worth a shot. And if people took the money that they put towards scratchers and and redirected that into something actually going to benefit them, guaranteed. I mean, that's a huge thing. I think that you kind of laid out for anyone listening is like, this is, like you said, this is not a gamble. This is just facts. This is how it's
Yeah,
been.
well,
This is how the market works.
yeah, I mean, there is risk, right? I mean, there's risk in the
Of
market
course.
and nothing is guaranteed. I mean, there are products out there that they say they guarantee, right? Like an annuity, but they're expensive.
Right.
But there's risk, right? Like you saw somebody invested in early 2008, they lost 25-30% of their money. They were putting it in, buying it, and it's still going down. But
Still
they
going
stuck to
down.
the plan.
Stuck to the plan.
And, whatever, what was that, 15 years later, 10 years later, it was, much better for them. And a lot of that is that you're buying those assets that pay you to hold on to them. So not just in price appreciation and dividends. So every time a dividend spit off, it actually goes and buys you another share of that holding you own. And that's how people kind of continue it. That's that whole premise of compound interest, right? You keep buying, that sells off, the dividend gets paid out, and instead of taking that dividend for you, you put it right back into it, or it will automatically do it for you if you so
Right.
choose. And that's where you get some of that compound interest, benefit from.
And now, do
We can
you
get more into that some other time.
Yeah, absolutely. Now I know we stuck in one direction today, and that was, our intention. But just because you brought it up, especially in one of your earlier slides when you were talking about the different markets, the
Mhm.
different types of investment markets that people could partake in, is that something, without giving advice, just as a general view, is that something that you kind of are open to for your clients to do? Let's say if someone had 400, instead of doing it this way, would, if they were open to, let me do 300 that way, but I want to do 100 crypto, or I want to do
Yeah.
100 in something else. Do you ever kind of advise that, or do you try to stick with a certain direction up into a certain price point? How do you work it?
I mean, number one is, from my standpoint, is diversification, right? So if you do want to add more assets, I think that's a good thing, right? Owning real estate is great, even if it's just the house you live in, but also crypto or the Bitcoin or whatever the space you're looking at. It's just
Yeah.
another asset. Now, I wouldn't say bet the farm on any one thing. That's why we diversify. I showed us a very simple portfolio, just buying US, international, and bonds. Like you can literally do it with 3 ETFs. However, if you're a little bit more savvy or you understand a little bit more and you want to add a little bit more dynamic to your portfolio, then absolutely. I mean, adding commodities into your portfolio, adding cryptocurrencies into your portfolio, adding real estate, adding whatever it may be. I mean, I know some people who, they buy whiskey and like really really good whiskeys, and they save them as an investment strategy. I don't personally do that, but I mean, I do know people who do that, and so there's other assets out there. There's other markets, right? I just was speaking on, and I think the thing is, I said that because when people say, "Oh, the stock market," or the market,
Right.
like, well, which market are you talking about?
Right.
Because they're all a little different, right?
Right.
And so absolutely. I mean, diversification is a great tool. I think that over time, crypto in general will be the problem with in our, from a stock broker, is what I was at one point, from a stock person's perspective who's been doing this for a long time. The problem when you analyze a company, you're looking at their cash flows, right? And how can that cash flow help them grow? What's the future for them? Have they taken on too much debt that they're going to have to, raise more money and the stock price is going to fall, whatever it may be, right? That doesn't really translate well into crypto. So most people on Wall Street are going to be like, "Oh, crypto's a scam." Right? I mean, Warren Buffett says it, or all these people say it, but I think the problem with it is those traditional ways of looking at a company don't necessarily make as much sense in the crypto space. I think over time they will, and they will become more of a traditional asset on the stock, from a normal stockbroker or investment advisor, financial advisor's perspective. From my perspective, I already kind of see it that way, which I wouldn't call myself a trailblazer because I wasn't the first one, but I was definitely a lot earlier than other advisors to, allocate towards crypto investments for my clients. I
Yeah.
haven't owned any in a while, but I do see benefits of it. Absolutely.
Gotcha. All right, ladies and gentlemen, what we told you in the beginning is that we were going to get you step one. Step one, and we were going to simplify it. And I would say that, and James, you let me know if you agree, that it sounds like step one is this portfolio visualizer. It feels like that's a great opening for someone because it kind of allows you to look down the road a bit. It allows you to make adjustments to the number that you feel comfortable with putting forth towards this plan. It allows you to kind of see the plan. Sometimes people need to see it and recognize that, as you said, there are risks. But if you stick with the plan long term, if you give it its time to grow and build, no different than investing into your child. Like you said, we make investments all the time. You don't invest into your kid for 3 years and then push them out the door and wait, a few years and go, how did it work out? You don't talk to them a couple of days every year and hope that they're going to become the best they can be. It's a steady, long-term investment that will show itself down the road.
Yeah.
So,
Well,
so
we hope it does, right?
right. So, portfolio visualizer might be step one, and also I think it's a good step one because it seems like it'll also kind of show you your step two. Like you said, some people have an investment strategy with their job that they can kind of look at what their input is and what the company is going to match. Some people might have a small business and they know, well, maybe this amount of my clients, this money gets kind of chalked up to my life and whatnot. But I do have this small client. They don't give me a lot, but I make around $300 a month from them. If I just took the money from that one client, that small client could end up being a big deal later on in my life. So
Yeah, absolutely.
yeah,
Absolutely. And things happen too. I mean, just because you save the money, your plan is for retirement. Unfortunately, things happen. And you may have to tap into it. I'm not saying that it's always not recommended to do
right.
because you kind of deviate from the plan. But it's just another. And obviously, if you should have a safety savings, right? Everyone should have like a 6 month savings or 3 month savings, or whatever they can
Yeah,
afford. And obviously, that takes time. That always suggests with doing that first, especially if you have responsibilities like a house or children. If something
absolutely.
were to happen to you or you lose your job, you'd always want to make sure you have at least 3 to 6 months on hand. So I would always suggest starting there first. Like maybe you do save that in cash there, but then when you have other money and you say, this is my long-term goal, really look at the investment capital markets, do some research, reach out to advisors if you need to, or maybe people who know more than you about it, and put some to work and think about 40 years down the future, which I know is difficult to do right now, but still.
All right, man. Last two things that I want you to talk about, and we will conclude this episode. I'm hoping everybody got a lot out of it. Please go back, listen to it again if you need to. We tried to slow it down, but there's a lot of information in anything that's worthwhile. So take your time, get the information as best as possible. So the last two things. One, I want you to talk about, we talked about tax deferred. I want
Hmm.
you to tell us what the taxes look like. Let's just use right now, because obviously we don't know later on in life, but right now, what the taxes look like when someone is pulling out their money from a capital investments. And then the second thing, or the last thing, will be just letting people know once again how to reach out to you if they would like to have more information and direction on this journey.
Yeah, absolutely. So there's all different types of accounts, and you can just think of them as wrappers. And really, all they do is define how taxes are assessed on anything you own, right?
Yep,
So
WRAPPERS, guys. He's not
wrapper,
saying
yeah.
he's not saying they make records. He's saying
Like a candy wrapper, yeah. So so essentially, you have taxable money, which would be just like, say you had a normal bank account or a brokerage account, and you owned an investment in that account.
yep,
If you were to sell that investment while it's in that account and there's some type of a profit, in that year, you will be taxed on that profit. So your whatever it cost you plus what you sold it for, that in between is what you'll be taxed on. When you have what's called in a tax deferred account, which is like a 401k, an IRA of any sort, so you have simple IRAs, SEP IRAs, just to say a traditional IRA format, which are all they're all similar to that. You can buy and sell in that all day long. Now, are some assets that have tax consequences if you own them. I won't get into that. That's kind of complicated stuff. But essentially, you're only taxed on when you pull money out of the account and it comes to you as income. So if you have a high income, you want to be careful about pulling money from your IRA, right? If you're just right next to that next tax bracket, then you want to be careful how much you're pulling out of that IRA as well too, because it might push you into the next tax bracket, which could be a problem. But you're pulled on the money you pull out, it comes to you as income. So say you get paid 50 grand one year, and you pulled out 10,000 from your IRA. Now all of a sudden your income's 60,000, and they're going to tax it based off of that. And if you pull it out before you're 59 and a half, you'll also have another 10% penalty, right? So on top of the taxes you owe. So that's an important caveat as well. However, there's also which would be tax-free. Roth IRAs are considered tax-free. So essentially how a Roth IRA works is you're putting money into that account after you're already taxed on it from your paycheck. So you get paid, it goes in your account, and you say, hey, I have this Roth IRA, I'm going to put $200 in there. So the money that you put in, you put your $200 in there. The money that you put in, you can pull out anytime. You can pull that money out anytime, and there's no taxes, no penalties, nothing. Now the growth or the gains in the account the account at least has to be open for 5 years. If it's open for 5 years, anything you pull out of there is state and federal tax free. There may be penalties if you're under 59 and a half, so roughly 10% on the high side. But you got to do your own research. What makes sense? I mean, I see people, they'll put a bunch of money in a Roth IRA. They keep putting money in every year, and you have maximums for Roth IRAs, right? I think it's like 7,500, maybe 6,500 for the year. I could be wrong on that. I think it's 7,500, but every year. But they'll put it in for 4 or 5 years, and then they say, hey, look, I put like $40,000 into this thing over this time frame. I want to use this, pull it out, and buy a home with it. Sure, why not? I mean, you pull out anything you put in there, go buy a home, and you didn't have to pay any taxes on that money, right? You could have had that in there growing, but as long as it was just the contribution, you're good to go. If you wait 5 years, then it'll be state and federal tax free. In that case, for any of the gains, but anything you put in, you can always pull it out tax free. So those are the differences in taxes, and that's all that as again, it's like a candy wrapper over the investments you own. That's really all it is how you're taxed.
Gotcha.
Yeah.
You did open up one more question, just because you said it. I think I forgot. So that's right. When you were saying it gets taxed just like income. So if you pulled out 10,000, it would just add, 10 to whatever else you made that year. Do you know? And if it's too complicated, we can save it for the next one. But what type of strategies do the big boys, the big players use to get those gains and somehow get access to it without just taking it out as income? Are there ways to do that if someone listening got to that $2.5 million spot, are they going to have to give the tax rate of 2.5 million back, or is there a method for them to get more of that money?
Well, I mean, typically with a IRA, like if you're taxed when you pull it out as income, I mean, you really only want to pull it out when you need it. So you're not taking it all out at once, because unfortunately, if you do that, you will for sure be taxed on it as if it was income in that year. Say for instance, you needed $30,000 from the account or something. What you could do is just wait till like December 30 or whatever late December, pull half of it out, and then on January 1st, pull the other half out. So you kind of spread it over 2 tax years. You also, a lot of people, if you have that much money in an IRA, I'm sure you have other assets. You take losses on other assets, right? And so you may be able to write off some of those losses towards some of the income that you have.
Yeah.
There's ways to do that. I mean, but mostly with an IRA, you're talking about getting taxed. There are other options out there. They usually exist in the form of insurance products, where you have like a life insurance. Say it's there's one that I've heard about, and I don't want to talk too much about it because I don't know a ton about it. But say you have you need like a term life insurance policy, which tend to be fairly inexpensive. But what you do is you overfund it. So maybe your term policy is $30 a month, but you put $500 a month into it, or maybe it's $1,000 a month into it. It actually goes into a Roth style account. And there's no maximums, from my understanding, that you can put in there. And and it gets invested, and you can access it anytime, pull the money out anytime. No taxes, no penalties, from my understanding. And I need to do a little more research on that to see how accurate that was, but that's another interesting strategy. There's a lot of strategies you can do out there. Unfortunately, taxes are one thing that's really difficult to get around unless you own a business in like the Bahamas or something.
Right. So, and I would assume, yeah, because you're still making it here. I was gonna say, even if you're investing, into international markets, it doesn't change it. You got to pay taxes.
Well, if you're an
You
American
have
and
to.
you make, yeah, the one thing with America, if you're an American, you make money overseas, you also have another tax to pay, right? So, and they get you on that as well. So yeah, taxes are one thing that's hard to get. I mean, within the legal realm, there's a lot of ways to, not pay taxes, but usually that's because you're investing the money in businesses or whatever it may be and other things, right? And you have losses to write against and stuff like that. But for the most part, I mean, taxes are kind of just an unfortunate consequence of that.
Yeah. All right, James, how can they get in contact with you?
You can reach out to me on my website. It's www.oliviawm.com, and I think you'll probably put it in the video, but you can reach out to me on my website. You can set a time with me right there, straight from my website, and we can chat, whatever you guys need.
Awesome, brother. I appreciate you. This has been very helpful. I already know, to a lot of people. Hopefully you guys out there will take heed. Don't wait. Start with step one. Develop a plan. Do something that makes sense. Don't have like just have had a great payday. You landed some big contract and now you think it's always going to be like that. Don't do that. Play the laws of averages. Do what makes sense for you, knowing your lifestyle. If it's only $100 right now, start with $100. Don't use the visualizer. See that if you put 500, it would really work. But then you're like, I can't do 500 to get to 3 million, so I'm just not going to do anything. No, start with what you can, and later on, let it grow, let it build, add some more. No matter what you do, it's going to be better than if you just saved it as cash. Saving it as cash does not account for inflation. You're pretty much losing money as it's just sitting there. Make your money work for you. You work hard for it. Let it work for you back.
Absolutely.
James, it's been great. Yo, pod is good.
All the time.
And all the time.
Pod is good.
Thank you, sir. This has been episode 19. My man James, Anadon, the investment shark. This is the Pod is Good podcast. Please follow us, subscribe. If you enjoy the content, tell somebody about it. Let's bless everybody, be entertained and empowered. Till the next time. I'll see you.
All right.
All right, my guy.
All right, have a good one.